Hey everybody, Happy New Year and welcome to Andika's market forecast, projections and guesses for 2023. That's right, I'm going to try and outline a roadmap for what I think could be where the markets are at for 2023. I know it's risky putting everything on the line to say what might happen in a year's time, but I'd rather put some ideas out there so we can all talk about them, get a feel for where things may go, strategize over those ideas, than just be someone who just wants to float along and hope for the best on what could be still a very turbulent market year ahead of us. So the first thing we need to recap on is where we're going into in this new year. Pretty well much we're basically going to continue on with a rate hike or a hawkish mode from the federal banks or central banks around the world, because they are here to try and slay the inflation dragon. So we can see here the current Fed funds rate is 4.5% and the current RBA cash rate is 3.1%. Now, the US inflation is running at 7.1%, and here in Australia it's 6.9%. Now, in my opinion, when the bankers come back to work, which won't be until February, I'm of the opinion that the US Fed will be looking at further rate hikes. Now, the magnitude of the hikes that they've been doing is slowing down. The last rate hike they did was only 50 basis points, with the previous ones being in lots of 75. I happen to think that in February, they'll go another 50 basis points. In March, then they'll slow down to 25. And then in April, another 25. That'll be another 100 basis points, which will then take the US Fed's fund rate to 5.5%, which is pretty much then what we can call the terminal rate. That's where I think the Fed will then pause on hiking, but they'll stay in that pause for a considerable period of time. The market's hunger for the pivot to happen, and the pivot would mean the Fed, for example, reverses their hawkish stance to a dovish stance. In other words, they go from increasing rates to decreasing rates. I don't think it's going to happen until probably best case scenario, probably third quarter of this year, probably even fourth quarter. They really are, determined to slay the inflation dragon. In Australia, I think our RBA will continue the rate hike increase of 25 basis points for the next 3 months, starting in February. So in February, they'll hike rates 0.25%, in March 0.25%, and also in April by 0.25%. That'll take our RBA cash rate to 3.85%. I think that's where our terminal rate comes in. And I think the RBA will do the same as the US Fed. They'll then maintain that pause for a considerable period before they then start to look to pivot and lower rates. Again, inflation in the United States is at 7.1%, and in Australia it's at 6.9%. Ultimately, they will come down. Inflation will start to come back down, but I think what the central bankers want to see is they want to see inflation obviously come down and end up crossing where their cash rate is. Ultimately, I think they'd like to have the cash rate just above where the inflation rate is. If that event happens, then that would actually encourage people to start saving their money a bit rather than spending it. It all depends just how much of a dynamic the central banks really want to tie down on the inflation dragon. So that is what I sort of think is where we're going to be in that big macro space coming into the first couple of months of 2023. So how does that look just on a technical side of things? Well, if people were looking for a big rebound in 2023, following that theme I just mentioned with the macro, the only factor you can pray for is then when the Fed ends its quantitative tightening or the RBA ends their quantitative tightening. And as you can see from the chart, you can see here, in this case, it's to do with the US reserve balances. And you can see how that was them just absolutely letting rip, opening up the taps and crushing interest rates. And as you can see, the US market capitalization just followed it brilliantly. Then we got to basically into December of last year, and then they started to say, that's it. And that's when they started to tighten. And as you can see, as they're starting to tighten, so has the markets have fallen. So that's what the markets are looking towards. They're saying how much of that quantitative tightening is going to stay on until they go to the pause and then to the pivot. Well, at this point, I don't think we're going to be there for a while, as I already outlined. And if the risk is, of course, if we go to this one, and this is my favourite chart. Anyone who's been following my channel for the last couple of months would know I've been posting this particular chart up a lot. It's the current S&P 500 overlaid the same S&P 500 back in 2008 and 2009. And you can see where it notes on the chart that you are here. And it's just absolutely incredible how the current overlay of the S&P 500 is tracking pretty well against the 2008 and 2009 S&P 500. So the risk is possibly we could see some further declines in the shorter time frame, which sort of would make sense if we've still got a very hawkish Fed and a hawkish RBA pushing up interest rates, because that dynamic is sooner or later going to flow into the discounted models of how we value stock prices. So that's just setting the scenes for where I think we could be heading to, in 2023. Now, let's just have a look at the past, i.e. what we just went through in 2022, to get a gauge of what we might be looking at for 2023. So let's just now start with looking at a chart here of the ASX 200. So here it is here on a daily figure, and that's how the ASX 200 looked like over the year. And it basically suffered a 7.26% decline from where it started in January for where it closed in December. And you can see there's been plenty of opportunities where you could have, bought the dips and traded out on the higher ends. Two notable big ones were the middle of June and also at the end of October, but that's obviously easier to say with the benefit of hindsight. Now, here's the same XJO, but on the weekly, and this just goes to show you illustrate the magnitude of how much the ASX 200 performed after we had the beginning of the COVID pandemic. And you can see that sharp decline, which basically hit bottom around about the 20th of March 2020, where you can see the ASX 200 basically tanked down about 4,800 points. And then because central banks around the world, as I showed on that earlier chart, were just quantitative easing everywhere. In other words, they were just making sure interest rates just fell and fell and fell. We saw the ASX 200 actually crack over 7,600 points, in the middle of 2021. And then we sort of went sideways for a bit, had a bit of volatility, but you can see there, just on that weekly chart, where the ASX is now finished up. So that's just a general look at just how the market, unfolded in 22. Now, what I'd like to present now in the video is just a summary of certain stocks that I think are worth considering. Now, keep in mind, the ASX 200 comprises of the ASX's 200 biggest market cap stocks, the All Ords. That's about the top 500, but the ASX in total has got about over 2,300 particular stocks listed. So I'm not going to obviously go through every one of them. I've got a selection of stocks that I sort of like, and I'm sure you, the viewer, will have your own, and I'm sure you, the viewer, will be saying, I don't agree with that synopsis, Andy, and that's good, because so you should. The idea is just to present ideas so you can consider them and then make your own inquiries. Just in case anyone's under any illusion, what I'm presenting here would be at best general financial advice. So if you are going to then take on board what I'm saying here, make sure you chat to somebody. But I'm not giving anybody who's watching this particular video specific financial advice. Even though the company I'm the director of does hold an Australian Financial Services license, it is important that this video is taken in on the fact that I'm really just explaining my opinion on what I see going forward. So the first particular stock that I'll have a chat about is what I call the one-trick pony stock. And that's the one stock you can own when you don't want to own everything else. Now, it's actually an exchange traded fund, and in this case, it's called the STW, or the State Street ASX 200 tracker. And basically what it does is it tracks the ASX 200. Now, it would be pretty dumb to try and go and buy all the 200 stocks that make up the ASX 200. You could do it, but it'd just be really silly. It'd take a lot of work, and then try and balancing it up every day. So smarter people, in this case it's State Street, they put out a few years back now this exchange traded fund, and it actually tracks the ASX 200. And the idea behind this is, if you're somebody who knows you need to have a position in the market, but you honestly can't be bothered trying to drill down what stocks you need to go to, you just don't want to go to that level of difficulty, but you do know you want to own something there, this is probably the best one-trick pony stock you can go and own. Because as long as you've accepted that you're going to take on the market risk, meaning stocks go up and down, then this is actually not a bad thing to consider. Now, you can see here on the stats, basically in January of 2022, it was around $70.22 a share. 30th of December, it finished at $63.51 a share. So it declined by about 9.5%. However, it did pay out around about $4.32 in dividend, which has it on a yield of about 6.8%, which isn't too bad. So yes, it's underperformed in last year, but again, we showed you on the previous slide, the ASX 200 also underperformed as well. Take the dividends into account, and that just softens the blow. Now, if you own something like this, the beauty of it is the cost to own such a stock like this, or the ETF. You buy it from your stockbroker, you pay the brokerage, you own it. Now, if you own this for the next 10 years, it's going to cost you nothing in terms of management fees that come out of your account. Yes, they have an internal, cost to manage the ETF, but you don't see that. That's not something that comes in and takes money straight out of your wallet. So if you were to own something like this and review it every 2 or 3 years, you'll find the only real cost was when you purchase it from your stockbroker, and if you then decide to sell or sell part, it's when you pay brokerage there. So from a cost point of view, it's very, very efficient as well. It's one of the good things about an exchange-traded fund. Anyway, it's a very worthwhile ETF to consider. I tell you what, if you did own this, your accountant will love you, because it'll make doing the annual tax return even easier. So that's one that I, call the one-trick pony stock position. So the next couple that I'm going to go through, I refer to them as the smorgasbord of major stocks. Now, again, this is just in my opinion. There's a lot of stocks that make up the ASX, so obviously I'm not going to cover every one. These are just my personal preferences. So the first cab off the rank that I'm going to have a look at here is the Commonwealth Bank. Now, that's the Commonwealth Bank's daily chart for basically 2022. As you can see from the numbers, 4th of January 22, it was $102.51, and on the 30th of December 2022, it finished at $102.60. So it actually did nothing as far as price performance, even though you can clearly see there were 2 points in the last 12 months where Commonwealth Bank lost its lollies, but then regathered, lost its lollies, and then obviously regathered. It paid out a dividend for the year of about $3.85, which, based on the closing price, yields about 3.75% fully franked. Now, it's often deemed that the premium bank of the big four banks. It's always trading at a premium compared to National Bank, ANZ Bank, and Westpac. But it has that premium for a reason. I also always referred to it as the bank for the public servants, because prior to the Commonwealth Bank being listed on the Aussie market, it was a government-owned bank, and particularly all the federal public servants, that's who they all banked with, and they probably still do. So Commonwealth Bank, that's a stock I do like. It is a bit expensive in my opinion now, so if it's one that you would like to possibly acquire, or if you already own it, acquire more. Watch how the markets unfold over the coming months, because there's every probability it could be retesting around $95, $90, which is not completely unheard of. Now, another particular stock that I like, and it's also a bank, is Westpac. And here's the Westpac chart, also as a daily. And we can see here, in this case, it actually performed better than the Commonwealth Bank. Now, on the 4th of January 2022, its opening price was $21.66. On the 30th of December 2022, it closed at $23.35. That represented a 7.8% return on holding Westpac. Its dividend that they paid over 2022 was $1.25, which actually has it on a yield of about 5.35%, which is pretty good. And keep in mind, because it's an Australian listed bank, the dividends they pay are currently fully franked. That means they are paying corporate tax at the corporate tax rate of 30%. So if you are a shareholder and you receive Westpac's dividend and you're on a tax rate lower than 30%, say it's in your self-managed super fund, that surplus franking credit will come back to you as cash. So it's even a better yield. If we were to gross it up, it's probably closer to about 7.5% if we were to gross up the franking credit. If these things are all foreign to you, don't get too worried about it. They're things you can easily Google and, work out for yourself, or, talk to your stockbroker and they'll be able to help you out understand it. But from a sheer dollar point of view, I don't mind Westpac. One of the things I often look like is the fact that I can just about buy 4.5 Westpac for every one CBA. Now, that's a very crude analysis to do, keeping in mind there are probably twice as many shares on issue for Westpac than there are in the Commonwealth Bank. But I still, in my opinion, think this is a particularly good valued stock to own in a portfolio. But that's where I'll stay in terms of the banks. There's no point then talking about looking at NAB and ANZ, because at the end of the day, it's like buying a car. You can have 2 cars in a family and they can both be sedans for 2 reasons. Fine, but you don't go and get 4 sedans, do you? So the fact that I haven't spoken about ANZ and NAB doesn't necessarily mean they're terrible. It's just that, in my opinion, they're the 2 that I would be looking at. Now, the next stock to have a good look at now would be BHP. And here's BHP's chart for 2022, and very similar in terms of the return to Westpac. You can see there its opening price, 4th of January 2022, was $42.38, closed on the 30th of December 22 at $45.63. That represented a 7.67% capital return in BHP. Now, notice it's a lot more volatile. Notice the price swings in BHP. Notice it's had 3 very big peaks where it's well over $47, but it has a couple of times either tested slightly below or near $36. So it's one of these stocks that if you can time your entry on the right cycle that is being presented in the market, you can actually do quite well out of it. But timing one's entry is something you need to study up. And again, that's where you should be liaising and chatting with your stockbroker. So if it's a stock that you are wanting to acquire, but you don't believe the price is right for you now, talk to your broker and say, well, when it gets to this sort of range, that's when we need to talk and have a discussion about things there. But based on its closing price of $45.63, given its declared dividend in 2022 of $4.63, again, fully franked, it's on a trading right now on a whopping dividend yield of 10.15%. That's just incredible. Now, you need to be mindful that that's the dividend return based on its historical dividends that have been paid. The dividends BHP and other listed stocks will pay in the future will all be dependent on just how profitable they are. Now, BHP is a huge miner. They cover a lot of commodities. They're in iron ore, they're in base metals, they're in uranium, they're in a lot of mining areas. And those particular commodities are set by global markets, and they obviously have a cost. So take iron ore, for example. Iron ore's, I think, about $110 US a ton. In BHP's case, they can mine it for $15 a ton. So when they can mine it for 15 and sell it for 110, they're making an extremely generous and fat margin on that particular bit of iron ore. Now, if the price of iron ore falls, then their margins will shrink, therefore their profitability would shrink, and then their ability to pay out the big dividends they have been paying down would then shrink. So you've got to keep that in mind. It's called a cyclical stock that moves around with how the underlying commodities go. But one of the things that is in BHP's favour is all the commodities that they do mine and sell on the international markets are priced in US dollars. Now, their iron ore ops, their major ones, of course, are here in Australia. Now, they will be paying those costs in Aussie dollars and then selling the iron ore in US dollars. So that helps them out as well. Yes, when they report everything, it's always underlyingly in US dollar, terms, but they do get that benefit of the fact that the Aussie dollar is considerably lower, and that can also help them there. Another thing to keep in mind with BHP, and if you stop and think about it, it's pretty obvious. If we're going to go to a world of full electrification, then the biggest real beneficiaries of all that at the end of the day are the miners, because they are the people, they are the companies that will still need to go mine the resources. You need copper, you still need silver, you need nickel, you then need rare earths, and you need things like cobalt, and then you're mining the lithium, and you still need iron ore because you're still going to need to, make steel and all these sort of things. These companies are going to be the biggest beneficiaries if we're all moving in the next 30 years into electrification of everything. I once read somewhere that in 2050, if the West was all the vehicles were electrified, so everyone's driving around in EVs 100%, so take that as an assumption, the amount of copper alone that would be required to ensure that 100% of the vehicles come 2050, so that means every vehicle on the road is electrified, would represent more copper that was used between 1900 and 2020. And that is incredible amount of resources. I could go on with other stats about how much use will be required, and some of the minerals required are measured in 10x, 20x, 40x, 100x in terms of what's going to happen. So if we're going to go down this path, miners are going to be actually one of the biggest beneficiaries of that. And so that's something you need to keep firmly in the back of your mind. Another particular miner that I don't mind as well, in the same boat, but this is more of a pure play. In this case, this is Fortescue Mining. And now Fortescue is predominantly just an iron ore play, whereas BHP is a diversified miner. They have a lot of mining ops in a lot of other places, not just in Australia, but around the entire world. But this is how Fortescue managed to go for the year. 4th of Jan 1985 was their open. 30th of December $20.51 close. So that made a cap gain price there of about 3.32%. They did pay out a healthy dividend of $2.07, which represents on the closing price a yield just over 10%, again fully franked. Now, Fortescue is obviously under a greater control of the iron ore price. The iron ore price keeps booming, and they also have a very low cost to mine iron ore. Well, then their profit margins will be significant, and hence, if that's the case, then they'll be inclined to pay out more dividends. Keep in mind, their biggest shareholder also likes the big dividends that his company pays out, so he's sort of inclined to make sure that the dividend well is healthy and keeps running through. But remember, they are a pure play, and just like the BHP price, you can see Fortescue does have periods of price volatility as well. It spent a bit of times just peaking across nearly $21.50. You can see there on the chart, but it did get as low as $14.80. That was just as early as November of last year. So again, if a degree of patience, you can probably, hopefully, maybe pick up a stock like this while it's trading around its lows. So one to also keep in mind, because iron ore is a vital mineral. You can't make steel without it. You can't grow iron on trees. It comes out of the ground. It either comes from hematite or magnetite, and that's just how it has to be, people. And we're still going to need steel no matter what we're doing going forward. So that's another one. Notable companies to mention would also be Rio. No problem with Rio, but for the point purposes of this particular presentation and video and being mindful of the time, I don't have time to go through all the companies. But Rio is also a very well diversified miner as well. So, there's a bit of love for that one as well. Now, another stock that I really, really like, and, there'll be people out there saying, oh, you shouldn't talk about it. It's a petroleum company. You are evil. No, they're idiots. Let's just have a quiet moment and just stop and think at the end of the day. Fossil fuels. Oh, they're evil. We've got to move away from that because of the CO2 and other things. And we're going to go to electrification and all that. Okay, yeah, you can try all that. What's the word? Transition across that. We're going to, get over there. That's going to take a long, long, long time. Anyone who thinks it's going to happen like that is kidding themselves. Now, Woodside Energy, they have been listed on the ASX for a long, long time. Earlier in 2022, BHP decided to demerge out their petroleum assets that BHP had, because BHP had a very, very substantial petroleum fossil fuel book, and they basically said, we're just going to take that off the BHP structure, and we're going to basically plomp it over here, and we're going to do a deal with Woodside, and then Woodside come together, and they're even bigger. Now, Woodside is Australia's biggest energy company, biggest one. It's probably in the top 10. I haven't looked up the current stats, but they're big. And if anything you're going to see, a bit further in this presentation is just how well the energy sector is doing. At the end of the day, people are still going to be driving around in cars that are going to require either petrol or diesel. The trucks that are delivering your food and your furniture and your flat screen TVs and all that, they all run on diesel. Even those wind turbines that are spinning around and all that stuff, they have lubrication inside the mechanisms that are spinning, where the motors are that are generating. One of those big 200 meter plus wind turbines has over 700 litres of lubricant. Now, lubricant comes from petroleum products. And you know what? Those big blades that you see on a wind turbine, they're made of a particular resin because they need to flex and all that sort of stuff. They come from petroleum products. And if I was to try and list everything that comes from petroleum products, this video would go for 24 hours. It's actually easy nearly to say what doesn't come from petroleum products. But you think about it. The plastics that we use, and I'm not just talking about the plastics you put your shopping in when you go down to the grocery store. From all the products you get that you're going to use, it's in some form of plastic. So, these things are still going to be with us for a long, long time. And whilst I'm not going to use this particular video as a forum to go and rant about, where we're heading in terms of tackling, in my opinion, a problem that doesn't really exist, i.e. global warming, go tell that to all the poor sods right now in North America who are buried under about 20 foot of snow. The thing is, the market at the end of the day is saying we're going to move with this. Governments come in and put the heavy dead hand of their policies to tell markets, oh, you got to do this. You no longer can own a V8 come 2030 or whatever else that they do. At the end of the day, though, the best form to make change is when the consumer decides, you know what, I now want to buy this, and because I want to buy it, you're a point of demand. The people that make the cars and say other products, they notice that and they think, you know what, there's actually demand for this. Let's redirect some of that capital from making, that particular widget, and we'll make it this one now because we've got demand for it. Leave it up to the damn market to make the decisions. The market will get it right, because if the market gets it wrong, it's on their side that get it wrong. You then as a taxpayer aren't screwed. That's the biggest problem when governments intervene. And right now in Australia, for those who don't live here and know, we've got a government that's intervened and has put price caps on gas and coal. And they're doing that on the deluded idea that will save on energy prices. All they've managed to achieve is the big companies who are in that space will rethink what the hell are they doing in Australia. Next time I've got a couple of $1 billion to go invest, I'll go to another country that's got less sovereign risk. It's just absolutely mind-boggling. But I've ranted a bit off that, but I want to come back now to Woodside. Have a look at the stats on this, and this is where you can see what's important. January the 4th, 22, $22.67 is what you could have bought Woodside for. 30th of December 22, $35.44. It enjoyed a 56.3% capital gain. Now, yeah, it's volatile. Look at that chart. A lot of ups, downs, but you take the general push and trend of that chart, and you can see it was upwards and onwards. It made higher highs and lower lows. It also happened to pay out $3.06 in dividend. Based on its current price, again, of $35.44, that's a dividend yield of 8.64%. So here's an energy stock. Here's a stock that is demonized by the mainstream media, is demonized by the eco-loons who don't understand anything, and yet here's the market saying, hang on a sec, energy is important. People need to either heat their homes or cool their homes or move produce from A to B and a variety of other things that we need energy, and we want it now. 56.3% return. These companies are going to be around for a long, long time. So don't drink the Kool-Aid thinking they're going to disappear, because they're not. Anyway, Woodside's one to consider and put on, the smorgasbord list as well. Okay, let's go and have a look at some gold stocks. Now, this is interesting. Gold. We're in a higher inflationary environment. We saw earlier in the video that we've got the US inflation currently at 7.1% and Aussie inflation at 6.9%. So typically that means gold should be a particular asset class that should be doing well. And if that's doing well, then you should be looking at the mining stocks, the gold miners that are there. Well, here's one that has been around. It's Australia's biggest, Newcrest Mining. And again, here's their daily chart. Now, in this instance, you can see here, opening price in January, $24.49, closing price in December, $20.64. They've suffered a 15.7% decline in their cap. So if you bought Newcrest in January last year and held it for 12 months, that's what you're down on paper. They pay a very, very small dividend. It was only 40 cents. The yield's less than 2%. So, you can see here that this is a stock that has underperformed the marketplace. But it's one I'd like people to be mindful about, because if we are continuing to see a hawkish tone, which I believe we are, particularly in the first, quarter or even the first half of the year, then I think gold stocks could improve. Now, remember, gold stocks are leveraged off the gold price. So they're not going to, if the gold price goes up $10, they don't sort of go up $10 themselves. They're a miner. So, they're mining the gold. They have to process the gold and then get it extracted and then get it to market. So they've got costs in doing all that sort of stuff. And then obviously if the price of gold is higher, then they're more profitable. Because what happens with a gold miner, for example, they're out mining, so they've got an open pit, and let's say they detonate the first 2 meters of that particular pit. They then go and assay that entire pit. So in other words, they go in with a drill. They drill every meter, grab an assay sample. Basically, it's like crusher dust, whatever it is, goes in a bag, goes like down to 1.5 meters, and they take all that, and that goes over into these labs, and the labs then assay them. They do a chemical analysis to find out what percentage of that sample has gold. And then they come back and get a report, and then think of it as a big football field, this particular open pit mine, and they go, see that corner up in the top there? That's high grade. The drilling results are great. So they spray paint that red, and they say, see this other section here? It was medium grade. It wasn't too bad, so we'll spray paint there. And see that further corner down on the other end, opposite end? That was low grade. It was rubbish. It's not good enough. Okay, now they know what to go and excavate. So they go in there, they obviously mine the stuff that's marketable, and then obviously the high grade, they want that. They also mine the low grade stuff, but you know what they do? They stockpile it. They just put it in a bigger pile. But you know what happens? If the price of gold keeps going up, that stuff that was low grade now turns into medium grade. Then they make money. So Newcrest is one to look at. It's been an underperformer, but it could be something that could look to have a bit of performance, coming into 2023. Now, there's another gold company that I also like on the ASX, and this is Northern Star. Now, how's this for a mirror? This is where, picking stocks in a particular sector can be chalk and cheese. Look at Northern Star's performance. January 4, 2022, $9.42 is what the stock was you could have bought it for. It finished 30th of December 22 at $10.91. So its capital gain over that period was 15.8%. Notice it was basically a return significantly greater than Newcrest. In other words, if you bought Northern Star, you made 15%. If you bought instead Newcrest, you lost 15%. The differential between both of them is over 30%. It also pays a little dividend yield, not a lot, yielding at about 1.97%. And again, look at how this chart is presented. Look at how it actually hit a peak of well over $11.50 back around Easter time of 2022. It fell all the way down to $6.75 around about middle of July, as you can see there. Up and down, and then it just roared basically into the final third of 2022, and it's performed exceptionally well. So that's another one that I don't mind as well. So keep that one there on your radar. And just while we're on the theme, let's just look at this particular chart here. This is a chart that compares both Newcrest and Northern Star. So we can see where Northern Star is. It's the major coloured chart versus the lighter coloured Newcrest. So what's interesting, if you go to the earlier part of the chart, whilst both of them were in a declining position, Newcrest was actually a little bit better than Northern Star. But then we got to that point when there was a bit of a cross, and you can see that around August, and that was when Northern Star started to really outperform against Newcrest. And you can see now, as we've finished in towards the end of 2022, just how well Northern Star was compared to its cousin Newcrest. So it does go to show that you can have gems and duds in the same particular sector. Anyway, one to keep a lookout there as well. Now, the next series I just want to really just quickly talk into is what I call sweet and sour speculative stocks. Now, again, on the ASX in total, there's 2,300 odd stocks, and most of them are specky, penny dreadfuls, and that sort of thing. There's no way in the world I'm going to dive in and all that. I've just got two that I just want to really just bring up very, very quickly. The first one here is PointsBet. This is a gambling stock, so for those of you who have a position on gambling stocks, if you're not interested, then that's fine. But here's how she's traded basically for all of 2022. If you bought it back in January, you paid $7.17, and on December 30th, it closed at $1.49. It's lost 80%. It's been terrible. Anyone who said buy PointsBet back in January of last year, and you went into it, you've really done yourself a real disservice there. And of course, it doesn't pay any form of dividend at all. So it's just looking terrible. But what I want you to look at, though, is just have a look at the chart and where we are now. It basically has just started to turn a little bit. It's around about $1.48.5. Let's now have a look at the same chart, but this time let's look at it over the week. This is a weekly chart. So this goes all the way back until the actual very time when PointsBet actually first listed on the ASX. Now have a look at this particular chart. It is just incredible. Have a look when we're in July of 2019, and then it had a nice run up. So that was a stock that was sub $3. It ran up to around about $5.50, and then COVID hit, and it tanked, and it fell down to about $1.30 thereabouts. I think it was even a bit lower than that. Then look at the performance it ran. Look how strong that stock ran. And to think around the beginning of 2021, PointsBet was worth $16 a share. Now, if you were to also compare that run up to the NASDAQ and the S&P 500, you'll see the correlation's extremely strong. Not to mention, what did we have happening in that particular period? We had central banks around the world who were just trying to give away cash, just get rid of it. And interest rates literally were just collapsing. So PointsBet, being a betting and a technology stock, they do run all their particular betting platforms on an app. I'm not someone, by the way, who uses them at all. I don't believe in betting on stuff. I work too hard for my money just to give it away. But I understand that it is a company that is in a space, and their technology is very good. I just think this thing's been pounded into the dirt, and the potential for the upside going forward is definitely there. It won't be in the first half of 2023 for the reasons we said at the beginning of the video, that the interest rates are going to stay high. They're going to be in that what we call the pause for a period. The pivot's probably, in my opinion, not happening until third quarter, probably even fourth quarter. But when that happens, that's when you'll get risk on. Risk on means stocks like this, in theory, should turn around. So, in my humble opinion, I wouldn't go crazy, but anything under $1.50 is probably not worth bad buying for the view of holding it for 12 months, looking for that uptick, which will probably come, like I said, definitely in the latter half of 2023. So that's just one there just to take on board. And another one that we'll quickly also look at is Providence Resources. Its code's PRL, and as you can see here, back in January, 15 cents. Finished in December at 6 cents. It lost 58%. It's been terrible. No dividend yield. But for those that have been following this channel, I've been talking about this stock. They've got a very, very good story. They're in the processes, or they've been in the processes for over 12 months now, backwards and forwards with Total Urgent out of France, who, if I recall correctly, is either the third or fourth biggest energy company on the planet. And their particular shtick is to do with hydrogen. The idea is do a deal with Total Urgent to set up a very, very big solar farm in Western Australia, use that solar energy to basically create hydrogen, basically get the seawater, use the electricity from the solar to create electrolysis, and that'll separate the hydrogen and the oxygen elements. So basically you siphon them off, and then the idea is you can then have hydrogen. Got to keep in mind, hydrogen is the most plentiful element in the entire universe, but on planet Earth, it's only found in water. And in order to really get it, you've got to separate you got, remember, water's H2O, so you got to, so take away the oxygen out of the two hydrogen atoms in order to then create a hydrogen gas, which we can use as a hydrogen fuel source. And anyway, that's where they want to be. They're a specky stock. 6 cents. Again, you don't put the entire fortune into this. This is just something you would consider owning as a speculative play. And there are many, many more. And it's one of these particular stocks, if you want more information on, just like PointsBet, there's a realm of information you can get just by Googling, the particular companies and that sort of stuff. Now, I'll just get to the final points now. And this is a section that I like to call the precious commodities and metals that you can also look at, because markets have become much, much more sophisticated. Obviously, in the day, it was, if you wanted exposure to copper, you had to buy a miner that was in the copper space. If you wanted exposure, to any particular sector of the market, you needed to be in those stocks. And then we've seen the massive explosion of exchange traded funds that now specialize in certain segments. Like if you want to be in semiconductors, you can buy an exchange traded fund that just trades into the semiconductor space. If you want to be in the biotech space, I think you get the drift. There's just so many of them. There's so many providers. There's a lot of things out there. So I'm just going to share with you now just 5 ones that I don't mind and I think are worth looking at. So the first one here, and this is, again, everything here that I'm talking about for those that are watching this video internationally, these are all listed on the ASX or the Chi-X. Obviously, depending on the jurisdiction you're in, you've probably got something similar. So this first one here is the Global X Bitcoin ETF. So basically, it's an exchange traded fund that basically copies Bitcoin. In other words, you want to own Bitcoin, but you don't want to go through self-custody and hiding it on your own drives, and you're worried about the exchange you might be using could do an FTX and all those sort of things. Simplest way is you just say to your broker, buy this particular exchange traded fund, and it gives you instant exposure to Bitcoin. It's priced in Aussie dollars, so let's just look at its performance. Now, it actually only started to be listed on the market back in May 2022, and then back then it was at $3.89. Its 30th of December 22 price was $2.44, so it suffered a 37% decline in its price. Now, Bitcoin itself for the year 2022 was down about 64%. So it's not surprising that an exchange traded fund that is there to, copy or not copy to, be part of Bitcoin, is going to have a similar performance run. The reason it doesn't have the exact same one is obviously it only came on the market back in May 2022. Now, this particular ETF, every share or unit you buy is essentially giving you 1/10,000th of a Bitcoin. So if you were to go and own 10,000 of these, that would cost you, based on the closing price of $2.44, $24,400. That would then entitle you would now own 1 Bitcoin in Aussie dollars. So that's how you can get your exposure. Now, Bitcoin is a classic risk-on asset. Again, it's had incredible runs where it's cracked 60,000 US on 2 occasions, but all the cryptos are just, at the moment, no, they're out of love. No one likes them. But I'll tell you what, we get to a scenario again when we do start to see the pivot come in. That's the rate cuts. That's when we see the Fed go from hawks and to dovish and they start slashing rates. That's going to be one of the first risk-on assets that's going to take off, just on that metric alone. Other things that can make it move around are what's happening naturally within the space. There's a particular video I've just recently watched by Coin Bureau, and they're talking about how the BIS, that's the Bank of International Settlements, it's the bank of central banks, has written a paper. They've done a complete 180 on crypto, and and they're going to start to say that reserve banks around the world, if they're going to start taking a bit of that of their collateral into crypto, these are the rules, etc. That's going to go behind it. And the particular video, which I've got a link down below in the description of the video that you can look at. I encourage you to watch it just to get some more background information, because I don't want to spend an inordinate amount of time talking about this, but I think that's something that's worth having a look at also for 2023. And again, easy to get exposure, easy to buy, easy to trade, not a problem. So it's not something that you have to worry about doing your own self-custody, which I've got experience in doing that myself. I feel comfortable doing that, but I took the time to go do that. But this is a really good way of trading Bitcoin. Another exchange traded fund that we'll have a look at, and this time it's the Silver ETF. Now, a lot of people don't like these ETFs that trade on the basis of a metal or a precious metal. Now, these are, in this case, this is silver, and you can see it's had a pretty good return. 4th of Jan, $29.64, 30th of December, $33.01. So it did a capital gain growth of 11.3%. So, if you had your money in this compared to the ASX 200, this outperformed. It beat hands down. No dividend at all, because it's an exchange-traded fund that is basically trading against the spot, silver price. Now, silver is actually more of an industrial metal today than a precious metal used for jewelry. It has multiple uses in industry. One of the most fascinating things you can do with silver, because silver's got a very, very high connectivity for electricity, is you want to run an electric current. You can use silver. But what you can do with silver is you can make it into a paste, a very fine paste, but nevertheless a paste, not a wire, but a paste. And that will still conduct current. And that's very important. Basically, your standard solar panels that you put on your roof, the standard size of them, every one of them has roughly 20 grams of silver in it, because they use it for the conductivity of the electricity, among other particular compounds that are in there that make solar panels. The ones that NASA put in the spaceships and stuff, that's, in the satellites, they've probably got on average about, 90 grams of silver. They want even more conductivity and all that sort of stuff. EVs need silver. Your phones need silver. If we're going to go into more electrification, you're going to need more silver. It's as simple as that. So if you believe that's going to be the case and you want to have a position in that, now you can easily also buy physical silver. You just go to a bullion dealer and you can buy bullion bars of silver, big bars, and you can own it and that sort of stuff. But then you run the risk of, what do you do with it? Like, where do you secure it? I had a friend who bought a lot of silver, and he just said, I just went and painted it with a water paint, and I used them as doorstops, and then no one ever knew what they were, because they were black or red or something, and if you just scratched off the water paint, there was the silver. So you can obviously go own it as well. People don't like these because they think they're massively manipulated, and to an extent that is true, because commodities such as gold and silver have a massive futures market. and those are kicked around a lot by the big institutions. But that's another one to look at. And you can see where its code there is. ETP MAG is its ASX code. Okay, nearly getting there. Obviously, if we're going to talk silver, we might as well talk gold. The big gold ETF on the ASX, funnily enough, is gold. That's its ASX ticker code. 4th of January, $23.36 was its price. 30th of December, $24.89. So, it 6.5% return on that ETF. Again, you can see it's been pretty volatile. There's been lots of ups, lots of downs. It's most recently had that peak well above $25 per share in the ETF. But just before August, it was down around the $22.80 mark. So it's one of these, commodity plays that if you generally take the view that gold's going to go higher and you want to try and get exposure to gold, here's one way of doing it. If you want to get leveraged exposure to gold, then you've got things like Newcrest and Northern Star, which we talked about earlier. So that's another one to take a possible consideration in. And again, I'm only touching on the surface here. These are just my thoughts, just to, get you to think about what you can do, in the year ahead. Okay, and two more to talk about, and this one here is a really good one. This will really make the Echo Loons go nuts. We also have an ETF called Fuel. Yes, that's right. It owns all the basic energy companies around the world. Now, remember that particular chart that we looked at earlier on Woodside and just how well it was doing? So here was the Woodside, and what did I say? Woodside, 56.3% capital gain return for the 12 months. Just smashed it out of the park. It was just unreal. So if we look at the Fuel ETF, a very, very, very good 37.45% capital return over 2022. So 4th of January, you could have bought it for $4.70. 30th of December, its closing price was $6.46. That represents that 37.45% return. Sensational. And it even pays a small dividend yield of around nearly 3%. Again, very volatile, because obviously the big influencing price mechanisms in the Fuel ETF is obviously the current price of oil, and it's either West Texas crude or Brent oil, from the UK. Lots of things been going on, obviously geopolitically. Obviously, Russia's invasion in Ukraine hasn't helped. Mind you, though, there's been a lot of other aspects that have been kicking around, what the price of oil does. Again, with interest rates going up, that's designed to suppress demand, because they want to get inflation down. And then if that's a suppression in demand, then in theory, of course, then the price of energy should fall because you're not needing as much. But then you're in the northern hemisphere freezing your nuts off. Well, you're going to need heating oil and other stuff. You're going to want energy to keep going. So there's always ebbs and flows, going through the energy market and that sort of stuff. But this has been a sensational ETF. Again, one to put on a list, I think. And, price of oil, for whatever reason, because we're getting into higher interest rates, we're coming out of a terrible European winter, and that stabilizes. That means the price of oil might fall, I don't know, down to under $70 a barrel. This will fall because of it. Might represent a new price point. Have a think about it. Anyway, something again to talk about. That's all I'm sort of suggesting here. Something to talk about. And then, of course, I've been a bit rude to all the, what I call the Echo Loons and all that sort of stuff. But here's a exchange traded fund, even for you guys. And it's got the best name ever. ACDC. This is the ETF if you are believing in the batteries and electrification of everything. This is it. Here it is. Now, here's its performance for 2022. So 4th of Jan, it was $96.64. 30th of December, it closed at $84.83. Haha, you actually lost 12%. Now, I shouldn't laugh. It went down. There's a lot of factors behind this. You've got to remember there's a lot of dough going into this particular sector. So, you can overshoot things on the supply and demand equation. It pays a little bit of a paltry dividend yield. But the thing is, I wanted to alert people is if you're actually wanting to get a position in the battery side of things again, and this again covers a variety of companies around the world rather than trying to be stock specific. There are particular stocks you can go buy that are lithium miners, for example, but this is both the mining and the creations of the batteries. And again, if we're going to electrification, this is where it's all going to head to. So on a yearly basis, it was pretty terrible. But if I bring up here the the weekly chart, and this is where it goes back, beyond August 2019, well, that's a bit different. Look how well it performed. It's performed really, really well. So we're talking of an ETF that you could have got in there for like about $44, and December of this year closed at $84. Just for argument's sake, I haven't done the exact calculations, but it's essentially doubled. So you can see there are money flows there. And what's also important is when you're using charts, sometimes you need to increase your view. Don't just focus on the daily chart because you only see the daily view. Go to the weekly chart. It's a lot more to see, a lot more to take into account. So we're nearly getting up to the 55-minute mark. This is obviously a very, very long video, and I've spoken a lot as well. I can assure everyone for the rest of 2023, my videos aren't ever going to be anywhere near this long. But because it's the new year and I wanted to seed some ideas into everybody, get people thinking about what's potential opportunities that might be coming along the market on the time frames for these sort of things. I just wanted to start that to gel up because it's worth a discussion. It's worth being able to plan off that. So again, let's just sort of summarize where we've been at right now. I've run through the one trick pony stock. That's the S&P, the State Street ASX 200 tracker. Great if you just want a boring one single holding that very good, not a problem. I've gone through the smorgasbord of major stocks: Commonwealth Bank, Westpac, BHP, Fortescue, Woodside Energy, Newcrest, and Northern Star. One thing I didn't mention at the time when I was talking about those stocks, all those stocks that are on that smorgasbord list that I spoke about, they're also stocks that have a very, very liquid exchange-traded options market. And one of the things I like to do, not only myself, but also for clients, is own, say, BHP, own it so I can then get the dividend, but I also sell an out-of-the-money call option, which gives me extra premium on top of it. It's a great way to make solid returns. Now, again, I'm not going to spend time in this particular presentation going about it. In the description below, I'll put a link to what a buy right is, and you can go and watch that. Something I produced many, many years ago when I was much, much younger, but I still had no hair on my head back then. But using options is also a very, very good way to enhance returns in a sometimes volatile stock market as well. So they're all stocks that have a very, very healthy exchange-traded options market. And again, own the stock and sell the call. We call that a buy and write. Buy the stock, write the option, done at the same time. Or you buy the stock, own it for a little bit of a period, maybe to wait until it goes ex-dividend, or to make sure you are secure in knowing you're going to get the dividend. Then you sell call options that represent the same number of shares of what you own. Great way to increase the yield. Effectively, just for the sake of illustration, it means you can nearly double the dividend in holding the stocks if you get to write the options at right times. Again, a seasoned stockbroker who's got a good understanding of how the derivatives market works can help you do that and that sort of thing. So I'd be looking into that. Anyway, we're nearly coming into an hour. That's a long time to chat. So I'm just going to stop there. The major takeout is markets are still concerned that the central bankers are going to stay hawkish. And I think that's going to be the case. I still think come February, the RBA and the Fed are going to increase interest rates. I don't think they're going to reach their terminal rate until probably about April. So I think there's 3 lots of rate rises to come. I think the RBA's got 3 more rate rises of 25 points to take them to a terminal rate of 3.85%. And I think the US Fed's got also 3 more rate rises. How they deliver it, I got a feeling it might be another 50 and then a quarter and then a quarter, and that'll take them to a terminal of 5.5. But I then think they're going to sit on there for a while. As I said much earlier in there, inflation will start coming down. It will start coming down. But I think they're going to want to see, if I get my fingers the right way, inflation coming down to cross the cash rate. That's when we know it's there. That will then change the dynamic a lot, and then the market will be really then getting excited about a pivot and that sort of thing to happen. This is, of course, if we don't get anything out of the ballpark, random, a black swan event that forces us to do something. I mean, no one thought, we were going to get a pandemic at the start of 2020, and we did, and it unleashed the biggest amount of easy collateral and cash ever in the human race's existence in terms of markets, in terms of trillions and trillions of dollars. And we've now had to try and unwind ourselves back from all that sort of stuff, and hence we had the biggest assets explosion ever since. But we're in for still a rocky period, but I think there are some good quality stocks that you can look at to still frame up your portfolio. Again, this is just me giving a presentation, a summary of some thoughts. Make sure you do talk with your broker. And on that note, if you're not a subscriber, please subscribe. I try and drop a video a couple of times every week. The ones I normally drop are just pretty much a quick summary video, usually about what's happened in the US market, the night before. Remember, I'm trading here in Australia, and then so I get the information of how the US closed, what stats happen over there. Then I present a video quickly to say, this is what happened, this is where I think we might be looking at today, and throw some bits and pieces in there. So the idea of them is just to get a quick report. The whole idea behind this is to get some information, because information is power. As I said earlier, I'm actually the director of Andika. We hold our own Australian Financial Services license. You can see all our descriptions below and who we are. We've been around in the space for a long, long time. I myself have been in the space since 1996, and Andika's been in the space since 2006. So we've seen a lot. We survived the GFC, and I can tell you there are a lot of bigger players than me that didn't survive that run. So if we can be of help, you know where to find us as well. But the whole idea is just to get some information, and then with information you're better informed, and when you're better informed you will make better decisions. And sometimes when you're making decisions, particularly with investments, sometimes a decision of not doing anything is a correct decision. It doesn't necessarily always mean you got to buy something, or for that matter sell something. And likewise, you might be sitting on some stuff that's been doing well, and sometimes you've really got to look at it and say, maybe it is time to take some profit off the table and just consolidate and have more cash set aside. Going back to that favorite chart of mine, of the current S&P overlaid over the S&P of 2008 and 2009, we still got the potential for there to be some very, very rocky times on our market. So that's enough from me. I appreciate everything. Make sure you subscribe. Feel free to tell your mates about the video. Send out the link. I don't mind. It's all good as gold. And until next time, take it easy. Thanks again.